Let's turn now to our not old, but dear friend and colleague, not old at all, Deniz Igan. um, Deniz, as most of you will know, was at the IMF and now is at the BIS. And when she was at the fund, she was one of our most prescient commentators on housing markets. I remember her kind of calling corrections in a number of markets, Netherlands, Dubai, etc. And Deniz is here today to expand the conversation a bit beyond the US market, as we've been doing so far. Tell us a bit about what's going on in other advanced economy markets, and also reflect a bit on how the pandemic may have changed housing demand, housing markets in a fundamental way, which I think will address a question I think that Nina had wanted to ask about, some of the longer term structural changes that can influence the current conjuncture. So with that, over to you, Deniz, and sorry that you had to stay up so late to participate.
It's always a pleasure, Prakash. Thank you, and thanks to everyone, Richard, Mark, Julia. It's great to hear those views as well. So in the interest of time, I'm going to jump right in. Of course, the views are mine. Compiled with my colleagues Emmanuel Kolshin and Furchai Sharan Kitkul, and not the BIS. But what I want to show you is, if you remember one picture of my presentation today, is this is showing you basically the comparison of housing market, house price developments in a range of advanced economies in past recessions from 1990 to 2019, and what has happened during COVID. And I think it's a very, very striking pattern to see in terms of, in the past, we were used to, whether it was started by housing market or not, we would see house prices dip and then slowly recover, perhaps around, nominal prices would dip around a quarter later, and then we would start seeing the recovery. Sometimes real house prices just stayed stagnant a bit more, but this time around we didn't see any dip at all. Prices just kept on going and going, and this is not only for the US. Mark talked about it, but this is happening in other advanced economies as well. Not as much on emerging markets, but in many advanced economies that we have data on, we're seeing this pattern. And then the other thing to notice, of course, is that the dotted lines, when you look at the blue and red, nominal and real, they started diverging, and that's showing you the peak of inflation. What's going on there. The other interesting thing is when you turn to the mortgage side, the credit side of housing, again, very different pattern from what we have seen in the past, where we used to have household credit growing at a rapid pace, and then it would start slowing down. And once the downturn came, we would have households deleverage and household credit growth staying low for quite a while. And rates would go down, they would stay low for quite a while. This time around, this is not what we have seen. We haven't seen the type of, twin booms where house prices would go up and credit would go up. This has not happened. We had quite, 1.5% growth in household credit prior. You see the hump after the downturn, actually, that's related to the policy measures that were taken. And now only recently we're seeing some weakening of household credit growth, which is related to, of course, the red line going up, interest rates, as Mark mentioned, starting to come up. Now, what I would like to talk about next is how do we explain this very distinct pattern from the past. And one thing, of course, is financial conditions. And what I mean here is not only the credit, we talked about it there, it was not a credit-driven boom, but it is important to recognize that economic activity, thanks to all the unprecedented, monetary and fiscal measures that were taken, it recovered much faster than many of us thought. And exceptionally easy financing conditions boosted demand. It also compounded with the healthy balance sheets of households and their high, liquidity positions. And nowadays, before when we first started thinking about these issues a year ago, if a household was looking to be an owner occupier, they could borrow at historically low levels. And actually, even today, at 5-6%, this is still quite low, right? So when you think about it, if somebody is set to, household formation age, they have a preference for being an owner, then it still makes sense. And this is what this is again very common across countries. What we're looked at is the common factor across advanced economies in terms of explaining the house prices. And you can see the blue bars are what we used to see until 2015, and then the red bars you see in many of these countries it started increasing. So now 60%, about 60% of the house price movements we're seeing are attributable to a global common factor, which is not surprising. Again, pandemic was common. It was global in nature, and many of the policy responses were also common. So what has happened then was we have seen this increase in the portion of house price movements that are explained by a common factor. And you can also see this, the commonality of interest rates and their impact. What it started driving is a search for yield. And what we did was compare the rental yields you would get in different cities across the world to the bond yields you would get. If you were to, you had some money that you're sitting on, and you can either buy a place and rent it, or you can invest in a 10-year sovereign bond. And as you can see, in all of the countries that we looked at, rental yields far exceed the bond yields. Of course, things started moving, but the yield is there. And with that search for yield, we did see this strong demand and also the investor part that Mark talked about. On the institutional investor point, perhaps one thing to note, we did look at across countries, and in some of them, like the UK and Australia, you do see a pickup in the investor share or the institutional buyer share, but we didn't think that it was as common. So many of the small advanced economies, it's actually households, not as much the institutional investors that are coming in. And one last thing to perhaps note on the financial side is that with inflation now picking up, in many cases, households tend to see real estate as an inflation hedging device. So we may actually see continued demand, and I think that's something that could keep that idea going also with what's happening in equity markets. Now, turning to I see Enrique, I think something might have happened with my sharing here. Doesn't look like I'm able to move my slide, but okay, now we go. Now, financial side, okay, well taken. But the other thing that happened is that during the pandemic, and we talked about this in early presentations as well, some of you are familiar with, the demand for space increased. Right, it's not like you are, all of us went through that. You used to have this little desk at the corner. That's not enough. You need a real home office. And this is not only about, needing more space and moving from the urban areas to elsewhere, but you need to also think about, for example, younger professionals sharing an apartment with their roommates and whatnot, and realizing that everybody needs their corner and looking for moving and having their own space. So we see that again, it's not only a US phenomenon, which has been documented by several very, very good papers, but this is happening elsewhere as well. And when you look at the slide on the graph on the left hand side, you see pretty much, except for I would say Japan and Germany, the yellow bars are exceeding the gray bars, and the yellow bars are for houses. the price increase you observed for houses versus the gray bar is for apartments. And the other chart is showing in the US context, when you look at the three major cities, Washington, Boston, and LA, the commute time used to be, in 2015, the farther away you got from the city center, the less you would pay. But during the pandemic, that got reversed. So actually, urban centers enjoyed much less appreciation than those farther away did. Now, of course, what does that all mean? And we go back to our usual tools, looking at house price to income ratios, house price to rent ratios, building our, getting our models out of the shelf and running them again. What we did here is for, again, advanced economies, we looked at different models, and you can compare the pre-global financial crisis to the current valuation in this heat map. And actual valuations are stretched much more than in many of these countries, are much more stretched than they were before the GFC. So there are, of course, this is not true for everybody, but again, the small open economies, Canada, Australia, New Zealand, Sweden, they jump out. And what we do then is think of it, asset pricing framework and consider what could happen if interest rates were to increase. And just as a reminder, we did this exercise in March. And we were just thinking, okay, let's look at under different interest rate scenarios and calibrate it to the US data. And this is the red line you see there. If interest rates didn't move from their level in March and continued. And what the model suggested is that this collapse because of this speculative demand, and it goes to a certain point, and once it cannot sustain itself anymore, the bubble bursting in some sense, we would see a decline in prices even if interest rates didn't increase. Then when we considered alternative scenarios of 100 basis point increase or 200 basis point increase in mortgage rates, what the model suggests then is as long as this is gradual, you could see a leveling of house prices than a crash. Now this comes with a lot of caveats. This is our baseline thinking, and you could think of it perhaps as kind of a soft landing case. But it holds a lot of other things constant and primarily focuses on interest rate. And if something else happens, particular to employment and to incomes, then it's a total different ball game. Now, the macro impact, we talked about it a little bit. And again, I do agree with many of the points that were made. This is not GFC. We shouldn't, think about because we lived through a crash ourselves, it's going to happen again. And things are different on the banking side, on the household side. But again, there is some differences across countries. It is true that for many large advanced economies, household debt deleveraging happened, and we didn't see this type of rapid increase. But in small open economies, again, household debts continue to climb during those years, and in some countries, it's double household income, the current levels, and that can be predicted. The other dimension of potential vulnerability is that these numbers are all thinking about the average household, right? So the other exercise that we do is look at the debt service ratios, the gray bars on the right-hand side, and then say, okay, let's see 100 basis point higher interest rate. And by the way, when we're doing the exercise, we thought this was quite, a considerable shock and whatnot. Now we're already there and going faster than that. But what is interesting is that when you compare the yellow dots to the red dots, which is that the red dots are for households, the debt service ratio for households in the most indebted quartile. And in several countries, again, not surprisingly, the small open economies, you would see those households getting quite stretched. And let me wrap this up by just mentioning that in some of these countries, most notably Sweden, we already started seeing actual prices coming down in the monthly series. So it is not a extreme scenario anymore. So everything I went through quite quickly on the exercise itself, of course, but everything that I talked about is in this bulletin that you can find online. And thank you again. And any questions, I'd be happy to take.